Maybe you're watching this and want to spend $12,000 a month in retirement, but you have no idea if that's realistic, especially if you want to retire early. Maybe you're someone that's run dozens and dozens of simulations and still feel uncertain about what you can safely spend. And without clarity, the idea of retiring early feels a little bit stressful, maybe more stressful than it should, and you're constantly second guessing your decision. So in this video, I'm going to walk through the exact process we use with clients to turn that uncertainty into at least a very clear and confident income strategy so you can start to understand how much you can spend and how to think about early retirement withdrawals. And if you're looking for help for building a custom strategy, that's exactly what we do. We work with clients who want to retire early and spend confidently without constantly second guessing their numbers. Of course, I'll share more about that later in the video, but if that sounds like you, there is a link below. But definitely watch this video so you can start to get an understanding of what that spending might look like. And what I've seen is there's a common wave of stress when it comes to early retirement because they're still following retirement advice that might be completely outdated and no longer apply to you. The way that traditional planning has evolved so far has led people to believe that you need to get a high-paying job, work hard through endless hours, and then retire in your late 60s or your 70s and live out your days in your so-called golden years. My clients have worked 40 years to earn freedom, but not to sit there being afraid to spend it. And that's the irony. The system trains you to accumulate, but says almost nothing about how to actually enjoy it without guilt or fear. No one told you that the hardest part of retirement isn't necessarily saving, it's spending it. Most planning stops once you hit your number, but emotionally and financially, that's just the start of a whole new challenge. But what do I mean by that? So let me show you why so many people think they can't afford to spend $12,000 a month when perhaps they actually can. If we take Mike and Carrie, not real names of course, they're both 59 and want to retire soon with a $12,000 per month after-tax lifestyle. Naturally, the first question you might be asking yourself is, how much do they need saved? What's in their portfolio? And what withdrawal rate should we think about if they're retiring at 59? Now, traditional planning jumps straight to this. $12,000 per month is $144,000 per year. Divide that by classic 4%, and you're told they need to save at least $3.6 million. And at that point, most people stop. Maybe they continue to work. Maybe they think, I don't have that number saved, or I want to spend less than 4% because I'm retiring early. But what if there's two simple questions we could ask ourselves that can start to change how you look at actual retirement spending? This is, of course, number one, what other income sources will you have in retirement? And number two, what expenses will change when I do retire? Now, in Mike and Carrie's case, they'll eventually get Social Security, both of their Social Security, and then in 10 years, they'll have a $2,000 per month mortgage that will be completely paid off. That means, yes, if they want to spend $12,000 per month, that's not going to be for the rest of the retirement from the portfolio. It's going to drop significantly to closer to $3,000 or $4,000 a month, or maybe around $36,000 a year from the portfolio because of those other income sources and changing expenses, meaning they may need closer to $1 million at that point. Again, if we're just considering a simple 4% withdrawal rate. Of course, this is just a high-level picture, and there's a lot of different missing pieces you have to adjust upward for taxes in terms of the portfolio need, which needs to be accounted for. But you might be asking yourself, yes, I'm the same way, but how do I bridge that gap between now and when Social Security or Medicare kicks in? And how do you make sure you have enough wiggle room so you're not married to a monthly expense number? You can take more trips or purchase that thing you want to do without being completely inflexible. So the next time you hear someone say you need $2 million to retire early or $3 million to retire early, remember that number means nothing without context. When you understand this, you can start to see that the portfolio is actually just a tool to help supplement what you want to spend. Because like I mentioned, the hardest part of retirement isn't just saving the money, it's knowing how to spend it. But that raises the more important question, how do you actually plan for this? Beyond the whiteboard and beyond the simple back of the napkin plan, because if you've been following along, you already know your portfolio is just one puzzle piece to the bigger picture. So how do you handle taxes, timing of income, investment strategy, and income flexibility, because that can completely change what's possible. So let's go back to Mike and Carrie's plan, and you'll see why the typical advice barely scratches the surface. So I want to ground this with real numbers to help you get a clear picture. Again, Mike and Carrie are both 59 and they've saved about $3 million. So that's $600,000 less than what the 4% rule would suggest they need. But here's where things get a little bit more interesting. roughly $2 million of their total portfolio is in those tax-deferred accounts, $800,000 in taxable brokerage account, and then $200,000 in the tax-free Roth account. And that breakdown matters a lot because it's one thing hitting a number, but remember, $2 million of that is fully taxable at your highest income rate. Now, every retirement plan needs to be personalized. Your numbers will look different, and that's why we customize this. But to show you how we pull all these moving parts into a real income strategy, let's zoom out and look at a 10,000-foot view of Mike and Carrie's retirement income and how to turn that into a reliable spending strategy. So if they retire in 2026, our strategy shows they could actually spend more than $12,000 per month. Remember, Social Security and their mortgage were those two massive factors. In fact, we could start to spend about $14,000 a month, and let me explain why in just a second. But at first, you can see they'll heavily rely on the portfolio in those first several years of retirement. This is what we call the retirement distribution hatchet that makes up the flow of your income in the early years, once Social Security kicks in, and then throughout the rest of your retirement. And if you're quick with math, their spending is about $175,000 per year, or if we want to speak in withdrawal rate language, that is about a 5.8% rate. Now, most of you might be alarmed, and I completely get that, but here's why that's acceptable. Again, by 2035, their mortgage drops and spending dips. Then 2033, Social Security kicks in, further reducing the burden on their portfolio. So yes, $14,000 sounds aggressive, but later on, their total withdrawal rate is going to reduce down to 3%, thus taking a lot of pressure off the portfolio. And let me show you why this is important. This chart from Income Lab tracks sustainable withdrawal rates throughout history, and as you can see, they're rarely below 5%. Even the most infamous 4% rule was mostly shaped by the worst case scenario, where it did drop below 5% right here in the 1960s. But here's the problem. History is perfect in hindsight. This is a problem with factoring a perfect withdrawal rate when we do not know the future. It's fine knowing what I would have done in the past, that at times you could take double 4%, but the key when answering this question is being able to make adjustments. Of course, I wouldn't start with an 11% withdrawal rate, but if we go back to 1986 and we started with a 4.3% withdrawal rate, as long as you had a plan that could tap you on the shoulder and tell you when to adjust, we can see that we rapidly increase spending over time, and we see that we started too low with 4.3%, which historically has been true. But you can start to see that if you do happen to retire in a great market, you get pleasantly surprised over time with bumps in income. What matters is having a system that lets you adjust, not just a set it and a hope strategy. So instead of trying to pick a perfect withdrawal rate the rest of our retirement, we build a plan that watches the portfolio and adjusts spending as needed. You know, if markets are strong, we can increase income. If they're not, that's when we tighten the belt, right? We start to scale back temporarily with a buffer in place. And for Mike and Carrie, that flexibility is the difference between hoping they could spend $12,000 a month and confidently starting at $14,000 a month, knowing that, hey, we just need to adjust along the way. Now, even after you understand the withdrawal strategy, we're still not done quite yet, because the investments you own, they have to generate income and keep up with inflation for the next 40 plus years. And here's where most people go completely wrong when it comes to asset allocation, right? The mix of stocks and bonds, investments. They take your age, they plug in a risk score, and slap in a generic portfolio, 60-40, 50-50, or whatever the rule of thumb says. That might work in theory, but in my opinion, it's a lazy way to build a retirement strategy. If someone did that with someone like Mike and Carrie, it wouldn't reflect their goals, their tax profile, and their spending timeline. And that's a huge miss. What I often find when people reach out, they say, Matt, hey, I want to retire at 55 or 59, and I still could see that their portfolio is in one company, often with a very low tax basis. You know who you are if you're watching this. Now, most likely that stock has done really well for you. That portfolio that might have gotten you here over the last 30 years may not be the same thing that will make you successful over the next 30 years. You know, we have a client that's had this exact situation, a very popular high-flying tech stock back in the early 2000s that was painful to diversify because it had done so well. But that company went bankrupt years later. And I'll include a link to a great article called The Agony and Ecstasy, talking about concentration in the single stock and what that might mean for your future. So definitely check that out. When it comes to retirement, it just isn't about only investment returns. It's about taxes, income, and resilience through market drops, right? There's a difference between building wealth and maintaining wealth. So here's a simple framework for how to build a retirement-ready portfolio for early retirees like Mike and Carrie. So first, we know they need at least $175,000 per year from their portfolio early on, at least until Social Security starts, which means we want some of those investments in more stable, less volatile places like cash and bonds. That way, when not if markets dip, they're not forced to sell their growth assets at the worst possible time. In practice, we typically want to set aside at least 3 to 8 years of what they need from the portfolio in that low volatility bucket, often starting with the tax approach account, which you may be taking income first. Then we can focus on the long-term growth assets in those tax-deferred accounts, which for them, they may likely not touch for another 10 plus years based on the withdrawal strategy. Secondly, we diversify because no one knows which market will outperform in any given decade. Obviously, the US stock market has been on a tear over the last decade, but we can't assume the same thing for the next decade. We need to expect the unexpected. If we take the 2000, for example, the S&P 500 was one of the worst performing asset classes. In fact, if you retired with all your money in it, you might have had to significantly cut back income or go back to work, right? That's the benefit of owning things that perform differently. And when your portfolio is truly diversified, you reduce the reliance on any single outcome, ruining your retirement, and take a lot of guesswork off your shoulders. So let me walk through 2 just different stress tests. We'll go all the way back to the worst case scenario that most people worry about in market history. That is the Great Depression. Again, from 1929 to 1931, US stocks lost over 81% of their value. Unemployment hit 25%, and deflation averaged about 6.5% for 4 straight years. So what happens if Mike and Carrie, let's say they had a 60-40 portfolio, not a recommendation of course, and they wanted to spend that $14,000 per month? The blue line shows their actual income over time, and what you'll notice is they stay remarkably close to what they want to spend, even in a catastrophic scenario. There's a brief period where the portfolio hits this lower guardrail and triggers a spending reduction of a few $100s per month. But again, that's only temporary. And in terms of income adjustments, when we run a test, we can see that on average in the simulation, they expected an increase of their income about 5% every 2 years, and every 11 years, we can expect to decrease income due to market downturns. This is a fundamental difference between probability of success and probability of adjustment. What is the likelihood that we will have to adjust our income? And you're willing to make smart strategic adjustments, that's when you can start to think about early retirement and start to think about spending with confidence, because this isn't just about surviving a bad market and hoping you don't fail. It's about building a plan that lets you enjoy your life to and through bad markets, and that's how you finally get clarity on what you can afford to spend without waiting another 5 years just to feel safe. So when you hear someone say you need $3 million to retire, remember, it's not about hitting a number, it's about building a strategy that gives you the confidence for spending now, not just 10 years from now, without wondering if you're making a mistake. Because when you understand how to structure income, when you invest the right way, and when you're willing to stay flexible even through bad markets, that's when retirement starts to feel real. But maybe you're watching this and you're starting to wrestle with, do I even know if I'm ready to pull the trigger? Is early retirement actually for me? What are some of the signs that I know I'm ready to retire early? I made a video going through some of the top signs I see as a financial advisor that tell me my client is ready to retire early. Maybe you're starting to see those signs for yourself. So go check out this video right here where I go through those signs by clicking right here. Once again, this is Matt Calcagno, certified financial advisor at One Degree Advisors. If you'd like to talk to me or someone on my team about your plan to retire early, click the link in the description and we'd love to chat with you.